Let me now bring on board Saurabh Mukherjee, Head of Equities with Ambit Capital. Saurabh, good morning. Thank you for joining us. Saurabh, let me give you options. What do you want to start with, Cyprus or credit policy?
Let's start with the topic of the day, credit policy.
So what is your understanding? Do you think Reserve Bank of India will oblige, they will surprise, they will disappoint? And if they disappoint, then where will markets go?
I think the 25 bips rate cut is almost certain today. The more interesting aspect will be will they cut CRR? My sense is they won't, but I think it'll be interesting to see what they do on CRR, because I think the repo rate one is almost a given that they will cut, given where growth is and given where core inflation is, which is subdued. And the other aspect that all of us will look at quite keenly is the wording around future guidance, because most economists, most forecasters, such as including myself, expect a further 75 bips over and above the 25 bips that comes today. So the wording that the RBI uses on its future guidance will be interesting. My reading is 25 today, and then in the May policy, perhaps 25, or even more encouragingly, a 50 bips cut in May. And that totality of 25 today and perhaps a 50 bips cut in May should be a fairly meaningful impetus for the rate cyclicals in our country.
So, Saurabh, are you making a case that in the near term, Reserve Bank of India will prioritize growth over inflation? Because in the run-up to the credit policy, the kind of commentary we've got from Reserve Bank of India, honestly, it has confused most of us.
I think you're right in pointing out that the signals are a bit confusing over the last 3 or 4 months. But I think the easier way to read the RBI is to focus on its actions, not its words. And its actions over the last 3 or 4 months have been fairly emphatic in supporting growth. The words might be a bit confusing, but if you focus on the actions, then there's no doubt that the RBI is now focusing on encouraging growth rather than suppressing inflation. Inflation is muted, as you'd expect it to be 8-9 quarters into an economic downturn. So I don't think we need worry about that. The question is, how aggressive will the RBI calibrate its language vis-a-vis future rate cuts over and above the 25, which looks likely to come today.
So just hold on to that thought. I just want to mark the currency as well. Incidentally, the rupee is currently at a 3-week high. It's up a good 0.5% ahead of the policy. So going strong into the event should bring up the bond yields as well and show you how they're panning out ahead of the policy. Saurabh, just want to draw your attention to the events globally. And does it seem like what is transpiring in the Eurozone and in particular with Cyprus could have a contagion risk?
I think it is unfortunate as to what the European Union has done there. It's quite a remarkable decision to go after a small island in this manner. My sense is there will be a pullback by the EU once they have seen the consequences, the systemic consequences of what they're considering here. I think there'll be a pullback from this tax that they're imposing on depositors, and hence this temporary bout of panic around Cyprus, I think, will calm down. But it will leave a longer term lingering doubt in the minds of the peripheral countries, the Portugals, the Spains, the Greeks of the world, that hey, in return for bailing us out, at some stage the EU might tax our depositors as well. So from the perspective of depositor confidence in the peripheral countries getting hit, I think this is a much more significant event. I think Cyprus itself, the storm will blow over, and the offshore tax haven will return to a sense of normalcy in the coming weeks. But for Portugal, Spain, and for Greece, perhaps even Italy, the concern that one day their depositors might also get taxed is something I think that will be much harder to quell. And my reading is these countries, the peripheral countries, are already seeing fairly punchy capital flight outside the peripheral countries into the core of the European Union. How exactly these banking systems will cope with this in the year ahead is, I think, is an issue of concern.
Saurabh, but the counter argument to this is that Cyprus is honestly a one-off issue. Cyprus had become a macaw for tax evasion and money laundering, and the EU is simply trying to tighten the snooze there.
Well, if there was explicit referencing of such issues by the EU, then it would have calmed nerves in the other peripheral countries, but there wasn't. And with the German Chancellor having one eye on her vote bank, it's unclear as to what extent we will see such populist steps being repeated going forward. There's a clear concern in the peripheral countries that with populism on our mind, there could be more such actions taken by the German Chancellor, which in turn has a negative effect on confidence in the peripheral countries. So there is a loop which is clicked into place because of the Cyprus affair. And whilst I think the storm for Cyprus itself will blow over in a week or so, the damage to confidence for the peripheral countries could be more lasting. I don't think there's any two ways about that. This is a negative event for the peripheral countries in Europe.
And honestly, this negative surprise has come like a bolt out of the blue. But Saurabh, do you think in general, globally, there is some degree of complacency which has kicked in? Markets are suddenly ignoring all the bad news. They've ignored Italy, they've ignored China, they've ignored the problems in EU, they're ignoring that growth in US economy is still subpar. This reminds me of 2007 when the housing bubble had started, but the real recognition only came in 2008.
Clearly, if you leave aside the week-to-week sort of flutterings of the markets and you focus on the bigger term picture over the last 2 or 3 years, it's clear that over the last 2-3 years, markets have trended upwards. Equity markets have trended upwards, and the underlying driver of that, as we all know, has been quantitative easing. What's, I think, exacerbating the situation, what's leading to even more risk on, especially in America, is the fact that, say, somewhere between the next 6 to 18 months, QE will come to an end, the Fed will start raising rates. So ahead of that, the switch out of bonds into risk asset classes is becoming even more frenzied. That in turn is lending support to equities, which is in turn is sucking more people into the risk on trade, out of bonds into equities. For our market, this is the biggest pillar of support. Leaving aside our economic reform momentum, our interest rate cuts, our policy initiatives, the biggest supporter of the Indian market is this rotation by large US houses out of bonds into equities, and Indian equities is a beneficiary of that swing, as is global equities in general. I don't see that dynamic changing until the Fed switches QE off and starts raising rates, which will be somewhere in the next 12 months. Until that happens, the risk on trade, I think, stays in play.
Saurabh, what happens to the private banking lot, and especially after the expose and the kind of hit that these stocks saw, do you think the pain is now out of the system, or are people on the street still a little cagey about these names?
I think it's actually very interesting what's happened over the last 6 or 7 weeks. I was traveling around the States meeting clients when this whole money laundering episode broke. And whilst my take was and remains that that in terms of the P&L hit for private banks, this isn't a huge issue. The P&L hit in terms of regulatory fines, RBI censure and so on is fairly modest. What fascinated me was how jerkily FIIs reacted to it. It was almost as if they needed an excuse. They needed an excuse to sell private banks, and the whole money laundering investigation gave them that excuse. What I think it highlights is that there's a great deal of investor trepidation. There's a great deal of investor trepidation about Indian private sector banks, about their credit quality and the elevated valuations many of them are trading at. And I think it makes sense at this juncture to be heavily underweight banking in general and the private sector banks in particular. There's a lot of concern out there that these banks are overvalued, that their credit quality issues are not fully reflected in their P&L, and I think investors are looking for the first excuse to sell these banks.
Saurabh, now that we've discussed RBI credit policy, Cyprus, the big picture for the banking industry, should we discuss stocks?
Sure.
Why do you have a sell on Infosys?
So what I can see out there is that the investor interest is in large liquid names, and they want to play the cycle. It is evident that whether it's DIIs or FIIs, there's a degree of enthusiasm in participating in this economic recovery, participating in the rate cutting cycle. And from that perspective, the two sectors that come into play are auto. It's almost as if auto is almost the new FMCG. With FMCG valuations being elevated, a lot of attention is swinging to auto because the balance sheets here are in good shape, and whilst PV and CV numbers are not pretty, there's an expectation these will improve in the coming quarters. So in the auto sector, I think Maruti Suzuki is right at the heart of that story. It has come off 10-15% since its MSCI exit. It's a beneficiary of yen devaluation. It's a beneficiary of a weak rupee and its export potential. And it's something like 11 times FY14 earnings on our numbers. I think Maruti is looking decidedly tasty. I think there will be a lot of interest in that stock, provided there's some degree of solidity in the Siam passenger vehicle numbers. The second stock in the second sector people are looking at is the construction industry. L&T, as we all know, is the last man standing there, almost the last strong balance sheet in the construction industry. Beyond the set of events around L&T IDPL, the big question is how many of the big government projects that will get sanctioned this side of the election, how many of those can L&T land? To what extent will it bolster its order book? But that's a trade investors are looking at very closely. Should they buy L&T as a play on the government trying to rev the public sector capex engine into life? The third trade that people are looking to do is the deregulation trade. We know what's happening in oil and gas price dereg. We've had a couple of hikes in diesel prices, albeit we didn't get one on this weekend, but I think we'll get one once Parliament closes. So if you're getting diesel price dereg, if you're likely to get the APM price being hiked up this side of the election, ONGC looks like the obvious play on both of these dynamics. Diesel dereg, APM hikes this side of the election. So ONGC as a direct play on fuel deregulation is something that investors are also looking at. It's notable that all of these three companies have solid franchises, strong balance sheets. They're large liquid names, and I think these are the sorts of names investors will focus on as we head into the Q4 earnings season.
Really good having you on the show. Appreciate you taking the time out and joining us on the show today.